Hello everybody, my name is Craig Bennett, and today I'm going to get into another stock market video. In this video, we're going to get into investment types. Now, as far as things goes, it's a very important video before we move on to the future videos being longing, shorting, ETFs, and stuff, individual videos on these things. Because the fact is you might decide to go ahead and trade purely in one market or the other, or only a few different type of markets. So you need to know what you want to trade in, so you can skip around in the videos if you want. But even more so, what type of restrictions. This is a major thing. Restrictions doesn't only apply like before, where I talked about age restrictions and a few other things. Restrictions don't only apply legally, they also apply with how much money do you have to invest in the first place. Because if you only have maybe a couple $1,000s, going for the stock market itself, the actual stocks, may not be the best option. There's plenty other options out there, and something that you might want to take a look at. Now, with that being said, I will have a link down below that gets a little bit further into it. It's a pretty good article into how much a average individual should expect when they're trading on some of these platforms. But the thing to note is the numbers that it gives off, I found not to be 100% accurate, but it's fairly close. As far as some of it says you need to have $7,000. I found there's a lot of wiggle room in that. So if you have like 5,000 or something like that, you should be fine. But for the most part, it should give you a general ballpark on how much money we're talking about, and how much to expect from investing in these different things. Now, another thing I want to mention before we jump on in is trading in stock markets is highly similar to many other fields whenever you talk towards anyone outside. So be expected to that if you say I trade in the stock market, or I make money off the stock market or something like that, and you're purely making money off of stocks, be prepared for someone else to say, oh, I have bonds, I also trade in the stock market or whatever. The fact is most people consider all of these things stock market. Being from the cybersecurity, aerospace, and take a look at my background, and I'm all over the place, but being from all these other places, if you say that you're an engineer, people expect that you know how to build bridges. If you say that you know how to crack code, or basically you're a hacker, or you have understanding of hacking the system for cybersecurity reasons, they think a cracker is the same as this. They think all these things are the same, and it's not as far as technical terms. But you just give up, throw your hands in the air, and say, okay, whatever. I'll say it is. So note that. I just want to note that before we jump on in, because towards the average person, all this is the stock market, and that's why this course is labeled stock market. So with that being said, let's jump on in. Now, as far as the first and major one that everybody knows about is stocks. Stocks is fairly simple to explain. It's basically shares of a company. So basically what happens is you give money to a company, or to the firms to give to the company, and you own portions of the company. Now, one thing to note is if you're able to buy 51% of a company, or a group of individuals who own 51% of a company come together into an idea, then they can control the company. At that point, they're considered as the majority holders, so therefore they can do whatever they want. So if you have 51% or over, you can take over the company. You own the company at that point. 50%, that's not the case. So with that being in mind, what you have to keep in mind is that's a rare thing, but it is possible. It is something that you'll find billionaires buy out huge sections, or you'll find groups of investors who don't like who's in charge get together. I remember I owned several companies in the past, and several investors wanted to get together and vote to kick the CEO out, or to merge the company with some other company and stuff of this nature. It does happen, but it's really not that often when that does happen. More than not, even if everybody knows they got 51% or more, they tend to just let things run as they were before. Now, with that being said, there is some restrictions on trading stocks, pure stocks. And one of the biggest is, and this is for United States, not all places are like this, but trading the United States stocks is you need to have $25,000 in the investment account at all times if you want to trade more than, at this time, it's like 3 or 4 times before you hit your limit. What this is meant to do is prevent average people from over trading. It's suspected that if you throw down $25,000, then perhaps you probably know what you're doing. That's a reason that was told to me when I asked this a while back. But the fact of the matter is, it doesn't matter the reason. At this time, if you don't have $25,000 in the account, you can only trade up to 3 times in a week's time, in a 5-day period of time, per investment accounts. Very important to note that. So with that being said, let's say, for example, you got $15,000 to go around. So you put 5,000 in this, 5,000 in that, and 5,000 in their firm. So what would end up happening is you trade 3 times in one firm, trade 3 times in their firm, trade 3 times in another firm. The fact of the matter is this is not likely, it's not advisable at all, but it is possible to do things like that. It's not suggested, because if you really think about it common sense wise, it's not good. But I just want to mention that is possible. But again, it's best to just trade all your stuff in one account at best, maybe 2 accounts if you want to separate some stuff. But even with that, it's just best to trade stuff in one account, and that way you can condense everything into one area. Now, with that being said, once you're past that $25,000 limit, at this time, that means that you can go ahead and trade as much as you want per today. So keep that in mind. Also, keep in mind that it's up to the firm to actually do the force you to not trade past that given point. I want to mention real quick, it might not be a smart idea for me to mention this, but when I was with my first firm back in the day when I first started out, I actually turned $30 into, I think it was $350, because I was able to buy, sell, buy, sell, buy, sell, buy, sell. I didn't know anything about these restrictions, and the firm that I was with didn't really care, or at least they didn't say anything, or I was so under a radar that they just didn't know. But after some time, I had some violations that came up, and the firm about kicked me out for that. So it's very important to note that firms are there to protect themselves. Brokerage firms are there to protect themselves. So it's up to you to know these rules. And it's really important to note them in the first place. So it's up to you to keep up with them. So when you get your investment firm, when you get with an investment firm, it's very important to ask if you break one of these rules, or if they will update you if these rules change. So let's go into the next one, and that's IPOs. IPOs is initial public offering. IPOs is the reason why I'm actually making this an entire separate thing, because I will make an entire video on IPOs, how to deal with IPOs, how to get into IPOs and stuff like that. IPOs is basically when a company first becomes public, meaning first becomes tradable. You have a chance to be in one of the first public investors. There's a lot to this, and the research between regular stocks and IPOs is different, because one thing to keep in mind is you don't really need to know even the name of the stock, what the stock does, like the actual company itself. You just need to know the chart and if you can afford it, and maybe a few other things. But for the most part, I can tell you from personal experience, not knowing the name, especially if you're trading very quickly, not knowing the name and not knowing what the what products they put out or services they put out, that's not really necessary on a day-to-day type of thing. Or in some cases, even long-term. Like you can have an idea on this type of stuff. Okay, is this given product going to be necessary in X amount of time, or that you got some other products in line that will come out in X amount of time? Stuff like that. But for the most part, you don't need to know the gritty of it. However, with IPOs, you need to know that company thoroughly. And the reason why is because, again, there is no charts. It's never been public before. And you will be able to research this stuff well in advance. So it's not going to be like that type of thing. You will be able to learn about the public offering as far as the company going into public market. You will be able to be one of the first people to go ahead and be an investor. But at the same time, it's fairly important to note that it's the time to actually do a mass amount of research onto it. One thing I want to note here right now is stocks itself takes a high amount of capital, and there's the most, in my personal opinion and many other investors' opinions, stocks, simple regular stocks, is extremely high risk. But if I had to say between IPOs and stocks, IPOs is probably more risky because there's no prior information. You might think it's a great company. You might think it's the best thing in the world, but the fact of the matter is there's no evidence. If you're right, go something like Facebook. I think it started out around $19, $20, and now it's like almost like $150 per share. If you're wrong, well, at $19, $20, now it's cents. He basically, it's worth nothing. And I like regular stocks where things kind of leveled out and you know where things are going to be. For these, a single day, it might jump from $10 to $90. From a single day, it might jump from $10 to 1 penny. Who knows? So with that being said, it's fairly important to note that there is a high amount of risk, so there's a lot of research that needs to go into it. Personally, what I'll say is do not risk a high amount of your portfolio into an IPO or stock, especially when you're starting out. It does take quite a bit of capital to get into stocks in the first place. There's better options and stuff that you can make more money in a short run. So with that being said, let's go to the next one. ETFs. ETFs are exchange trade funds. They are traded and are viewed as highly like regular stocks. You basically on an ETF, and I'm making entire videos onto this particular one, but it's very important to know if you want to go ahead and trade in stocks and whatever, it might be worthwhile to take a look into ETFs, because ETFs are a lot more stable. Some ETFs, like say for example where I'm with Fidelity, or I might be on TD Ameritrade or something else, most firms, especially the higher end firms, there is specific ETFs you can get that you don't have to pay commissions. So, but the catch is, like with Fidelity, you can buy the ETF, but you have to keep it for 30 days, and there's no commission. However, the commission is simply the same thing as a stock. It's $4.95 right now. So the stock market's buy sell $4.95, so times 2. And with ETFs, the buy, it's free, but the sell is $4.95 if you sell it before that 30-day mark. So it's not that bad, but it's fairly important to note that some firms, they have it where if you keep it for some amount of time, then you don't have to pay commission. Just note that. Now, with that being said, I found ETFs, especially the bulk of them, to be fairly secure. It's very important to do a little bit of research into it before you jump on in, but it's fairly secure. And what happens with this is you can actually put more money down into an ETF versus a normal stock. I'm going to get into margin accounts and stuff this later on, but it's fairly important to note that ETFs are a great beginner tool. Now, the thing with ETFs is there's something called physical ETFs and future ETFs. Physical ETFs are if you're buying a commodity like gold or oil or whatever it may be, there tends to be fees onto that. Now, note, not all firms do trade physical ETFs, and same thing with future ETFs. But it's fairly important to note this because physical ETFs, they tend to have more fees attached to them simply because there's a physical asset that's attached to it. So something like gold, it has to be in some warehouse. It's your gold. Somewhere, it's like if you know IT for cloud storage, same thing. That gold's in the cloud for all you know, but for the most part, it's it does cost money to store it and all that stuff. So there you go. So that's fairly important to note. Physical ETFs, I personally tend to stay away from, but some people do make money off of them. Also, again, note the actual what the firm has, because they might have it where there is no fees if you buy certain physical ETFs. So note that. But again, these mostly invest in debit stocks and other securities. In most ETFs, you can actually see what type of sector it's in, so maybe technology, health, or whatever it may be. And you can tell based on politics and some other stuff what is really making money right now. And at this time, it's 2017, I'll say technology. Futures, you can go pure future or ETF future, but futures in general, it is a standardized contract sold on an exchange. So E-mini, S&P 500. But basically with futures, I'm going to get into an entire video onto that into itself. But note that not all firms do trade this. It's fairly important to note in case if that's something that you want to go with. But with that being said, if the firm does trade ETFs, chances are you're good to go. Options. Options are rights but not obligations to exercise contracts. These are sold both on the exchange and over-the-counter or OTC. Exchange trade options are more regulated and standardized, but over-the-counter options are partly specific, usually doesn't have a secondary market. Thing to note with options, I just want to add into here, is in order to trade options on most firms, you're going to have what's called a margin account. And if you're able to open up that, I would suggest trying to open up a options side to it immediately. Having the ability to trade options doesn't mean that you have to. So I would say just try to open it up as soon as you can, but understand and research heavily into options before you go ahead and trade into it. There's a lot of people who do make money into it, but it does take a lot of understanding. keep in mind there is a lot of differences between this and the regular stock market. So it's going to be very complex. I wouldn't say impossible or difficult, but it's going to be complex for someone who's pure stock market, just simple stock trader, to go to options. Again, it's not going to be impossible, but it's going to take a little bit of research. So now we're going into Forex. Forex is basically trading currencies. There's not really much to say on this besides it's highly leveraged and risky, but it is seen some investors do say it's worthwhile for new investors. I kind of disagree with that because of the risk value. You got to understand politics to a detailed level on that, and some people, they might be able to do it because of that, but in my opinion, that's just not going to be the case. But I'll still cover that in a future video in detail. Bonds is a type of fixed income investment, which is a debt from an issuer, so the government, school district, or something like that, and an asset the buyer. Basically, with bonds, is these are long-term investments. They tend not cost a lot of money, but they tend to be low risk, and in some cases they can be high yield. But as far as the amount of time it takes in order for them to pay off, it's a good retirement type of investment. So it's good for later years, and also for when someone goes up for college or something like that. So another I'm going to get into is mutual funds. A mutual fund is an open-end investment company that continuously offers its shares to the public. Investors purchase and redeems the shares directly from the mutual fund or through a broker for the fund, and not for an exchange. And one thing I want to note is mutual funds is worthwhile to take a look into and do a whole video into it. But what I'll advise between all of this is you need to, if you're starting out, never traded before, and you want something safe, something to help you get started, something to help you get understand it into the market itself, I'll say start with ETFs, exchange trade funds. As I said before, all it is just a pool money that it's like a mutual fund. A ETF is a pool of funds that offers an investor and some professional to manage the actual stuff. But for the most part, you're able to buy, sell, get in and out of that pool. It's very good, and based with ETFs, like one of the ETFs I'm in right now, it has Google, Microsoft, and a few other things into it, so it will tell you what is trading in, what the professionals within it is trading, and what they're aiming for as far as the highest companies it's trading for. But you can also look at the charts based on the actual funds itself to figure out how well the actual overall fund does. Again, for the most part, this tends to be a very safe bet compared to many others. Obviously, bonds and a few others tend to be safer, stuff like CDs, which I'm not going to cover into this course because it's too long term. But with this exchange trade fund, it acts so similar to a regular stock that as far as you have to research it, understanding the charts and stuff of this nature, that it, in my opinion, being safer than stocks, it's worthwhile for a starter person to put some of their funds into a exchange trade fund, not all of their funds. But anyways, as far as that goes, if you got any questions, anything else, then let me know, and I'll see you next video. Hope you have a great day.